All right, let's talk trading. Today, we are opening up the Trader's Toolbox and taking a look at all the core strategies that pros use to find their edge in the markets. We've got a lot to cover, so let's dive right in. When you first look at the financial markets, it can just seem like a total storm of random noise, right? Unpredictable swings, utter chaos. So the real question is, how do traders even begin to make sense of all that? How do they find order in the middle of all that chaos?
Well, they do it by using a really powerful set of tools. I want you to think of it like a master mechanic's toolbox. Every single instrument inside has a very specific job for figuring out the health and, the likely direction of the market. And today, we're going to open it up and look inside.
So, here's our game plan. First, we're going to start with the most fundamental layer, reading the chart's story. Then, we'll get into the tools for gauging market momentum, the speed and power behind the moves. After that, we'll explore some pretty cool alternative ways to see price itself. And finally, we'll tackle the biggest question of all. Is it better to master just one tool or to build a complete system? Okay, let's kick things off with the absolute bedrock of technical analysis. These are the tools that help traders read price action right off the chart, almost like you're reading the words on a page. First up, support and resistance. These are, put simply, just horizontal lines you draw on a chart. They mark price levels where the market has turned around in the past. The whole idea here is that these past turning points, they can become future turning points. It's all about market memory.
And here's how to think about it. A support floor that sits below the current price is a spot where buyers have shown up in force before. It's a memory of strength. And that resistance ceiling above the price, that's where sellers previously took control. So traders are always watching these zones to see if history is going to repeat itself.
Next up, we have chart patterns. These are basically specific shapes that you see price making over and over again. And they really fall into two main camps. You've got reversal patterns like the classic head and shoulders, which kind of suggests that the current trend is getting tired. And then you have breakout patterns like triangles, which tend to show up when the market is coiling up, right before a big explosive move. Now, market structure. This is literally the language of a trend. By just watching the sequence of peaks and troughs on the chart, traders can understand the market story. And just like grammar, it has rules. For example, a healthy uptrend is always defined by a series of higher highs and higher lows. It's that simple. See, you've identified a trend, but how deep is the price going to pull back before it takes off again? That's the question the Fibonacci tool helps answer. You draw it from the start of a move to the end, and it projects these key percentage levels where the price just might turn around. And let me tell you, those 38.2% and 61.8% levels are two of the most watched zones in all of trading. Okay, let's open the next tray in our toolbox. Knowing the direction of the trend is one thing, but how strong is that move really? That's where momentum indicators come into play. They're all about measuring the speed and the strength behind the price changes. This little table is a fantastic cheat sheet. So, a MACD crossover, that tells you that short-term momentum is starting to overpower long-term momentum. Price popping above a moving average, that shows you current strength compared to the recent past. And the super trend, it just simplifies the whole thing into a nice visual red or green line, making it super easy to see who's in control. Then you have oscillators, like the RSI. These are a special kind of momentum tool. And you know what? They work best when the market is just choppy and going sideways. They bounce between an upper and a lower band. When the indicator shoots up to the top, we might call the market overbought. When it crashes to the bottom, it could be oversold. Both are clues that a reversal might be just around the corner. Now this one is all about contradiction. Divergence is honestly one of the most powerful signals a trader can spot. It happens when price and momentum start telling you two different stories. For instance, if the price pushes up and makes a new high, but your momentum indicator doesn't, that's a major red flag that the trend is losing steam. All right, let's get to our third tray of tools. So far, everything we've looked at uses traditional charts. But what if we could actually change the way we see price itself? Turns out there are alternative chart types out there that are designed specifically to filter out the noise and give you a whole new perspective. So on the left, you've got your standard candlestick chart. See how choppy and kind of erratic it can be? Now look at the Heikin Ashi chart on the right. This method actually averages the price data to create these much smoother candles. It makes it way easier to just glance at the chart and see if you're in a clear uptrend with all green candles or a downtrend with all red ones. It's really all about cutting out the noise.
Renko charts take that idea even a step further.
They completely ignore time. The only thing that matters is price movement. A new brick only gets drawn on the chart when the price moves a specific amount you decide, say $10. This filters out all those tiny, insignificant wiggles and gives you an incredibly clean view of the dominant trend.
Okay, so we've got all of these chart-based tools. Pretty cool. But what if we looked completely outside of price for our clues? This is where things can get a little unconventional.
And for this, let's look at something completely different: moon phases. The theory here is less about charts and way more about mass psychology. The idea is that these lunar cycles might actually influence investor sentiment. Now look, it's definitely not a mainstream tool, but some traders do look for these kinds of correlations as just an extra layer of context on top of their main analysis.
And that brings us to our final, and I think most important section. We've just unpacked this entire toolbox full of different strategies. But does a trader just, pick one and hope for the best?
Absolutely not. The truth is, there is no single indicator or pattern that's some kind of magic bullet that works all the time. The real art, the real science of trading, is in combining these tools. It's about building a robust system where each tool helps to confirm the others.
So a trader might build a system that looks something like this. First, they use market structure to get the overall direction of the market. Let's say it's up. Step 2, they'll use an oscillator like the RSI to find a pullback to an oversold level. And then finally, step 3, they'll wait for a bullish candlestick pattern to appear as that final trigger to get in. You see, it's not about one signal, it's about building a case for the trade, where every step confirms the last one.
And this all ties back to a really famous saying in the trading world. The goal of a successful trader is to make the best trades. Money is secondary. The focus isn't just on chasing profits, it's on following your system and making high-quality decisions. The process is what really matters. When you get the process right, the results usually take care of themselves.
Which leaves us with one final thought to chew on. Every single one of these tools is really just designed to read the footprints of buyers and sellers on a chart. So is the ultimate goal to master the technical tools themselves, or is it really about mastering the underlying human psychology that creates those patterns in the first place? Something to think about.